When it comes to reducing our taxes, there are so many different ways to do it. We can save for retirement, maximize tax deductions, or move to the Cayman Islands. But one of the most straightforward and best tax reduction levers, in my opinion, is this: tax credits. So in this video, I'm going to talk to you about 10 tax credits you want to be aware of. Some may be relevant, others may not. But it's good to be mindful of them because we'll never know which one will come in handy based on our life circumstances. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. Before we jump into the list, let's first talk briefly about tax credits in general. In the spirit of reducing taxes, we can easily confuse deductions and credits, and it's essential to recognize the difference. In addition, please note I'm not an accountant and this is not tax advice, just information to help you increase your tax knowledge. Everything I'll talk about in this video is just a regurgitation of what is already written on the IRS website, so I'll have a link to each resource in the description below. Alright, with that said, let's talk about Tax Credit 101. A tax credit provides us with a dollar-for-dollar reduction on our tax bill. This differs from a tax deduction, which is a dollar amount the IRS allows us to subtract from our income, which in turn lowers our overall taxable income. In my personal opinion, this is where tax credits really shine. Because while a tax deduction saves us only a portion of our money, the amount that is taxed at the specific tax bracket, a tax credit saves us dollar for dollar regardless of our tax bracket. Let me give you an example. Let's say you're able to qualify for a tax credit valued at $1,000. This will directly lower your tax bill by the corresponding $1,000. Thus, $1,000 saved. But let's say you find a $1,000 tax deduction and you fall into the 24% tax bracket. This will save you 24% of that $1,000. So $240. So what do you think is more valuable? The $1,000 tax credit or the $1,000 tax deduction? Alright, enough about tax deductions. I'll have additional videos where we'll dive into tax deductions because both tax credits and tax deductions play important roles in reducing our taxes. But for the purpose of this video, I want to really focus on tax credits. Another question many people ask when it comes to tax credit is this: why do we have both tax credits and deductions? Why not just one? To confuse us, of course, and to make our life more complicated than it already is. Well, maybe partially. But in all honesty, most often tax credits are offered both in the federal and state level in order to incentivize specific behavior, most often socially responsible behavior. For example, we have education tax credits to incentivize higher education. We have healthcare premium tax credit to incentivize people to buy healthcare insurance. And we have energy tax credits to incentivize more energy efficient activities. And in order to qualify for a tax credit, taxpayers usually must meet a strict set of criteria relevant to that credit. For example, now in order to qualify for electric vehicle tax credit, your vehicle must be produced by a specific qualified manufacturer. They just don't make it easy for us, right? Tax credits also come in three categories: non-refundable, refundable, and partially refundable. Non-refundable tax credits reduce our tax liability by the corresponding credit amount, but only up to the amount that we owe. This type of credit is most beneficial for people who expect to owe money because it can lower or zero out our tax bill. But it won't result in a refund if the credit amount is larger than the tax bill. The best outcome with the refundable tax credit is a $0 tax bill. Not bad, but still not the best. Refundable tax credits, on the other hand, go beyond the $0 tax bill. It's the gold medal of all tax credits, because refundable tax credits not only reduce our taxes owed, but can also result in a refund. For example, if we owe $1,000 in taxes and qualify for a $1,500 refundable credit, we'll get $500 refunded to us by the IRS. I mean, it doesn't get any better than being paid by the IRS during tax time, right? A partially refundable tax credit is a middle ground between the two we just discussed. If your tax bill is lower than the credit amount, you may be able to get a partial refund for any remaining overage, but only up to a certain amount. The American Opportunity Tax Credit, a credit for qualified education expenses paid for an eligible student for the first 4 years of higher education, is a good example. If you calculate a $2,000 American Opportunity Credit, a maximum of $800 may be reported as refundable tax credit, with the remaining $1,200 reported as non-refundable. Alright, now that you have a good general understanding of tax credit, let's get into the good stuff. What I believe are the top 10 best tax credits out there. The first tax credit you want to be aware of is the Premium Tax Credit, also known as PTC. Enabled by the Affordable Care Act, also known as Obamacare, the Premium Tax Credit is a refundable credit that helps eligible individuals and families cover the premiums for their health insurance purchased through the health insurance marketplace. I've personally used it here in California, and once you learn the mechanics of it, I believe it is an excellent tax credit to take advantage of. It has saved my family literally thousands of dollars in health insurance premiums. And if you've ever had to pay for health insurance yourself, or even a portion of your employer-sponsored plan, you know how expensive health insurance can be here in the United States. A nice aspect of this credit, unlike other credits that we'll discuss here in this video, is that the credit is applied immediately when you purchase insurance through the health insurance marketplace. You don't have to wait until tax time to receive this credit. The government will pay 1/12 of the credit directly to your insurance company each month, and the insurance company will bill you for the remainder. Of course, if you receive too much premium tax credit because you underestimated your income, you will need to pay some back. But this also works the other way as well. If you didn't receive all the premium tax credit you're entitled to during the year, you can claim the difference when you file your tax return. There are a lot of nuances with this credit that I won't have time to go over in this video, but if you've been paying out of pocket for health insurance, you definitely want to research this credit. And even if you have high income, you might still qualify. Congress recently extended a relief that enables even taxpayers with income above 400% of the FPL, the federal poverty line, to qualify. I'll have a link to the IRS website on premium tax credit in the description below, so please check that out to get more details. The second tax credit you want to be aware of is the American Opportunity Tax Credit, also known as AOTC. If you have kids in college or about to, this is a very important tax credit you want to have in your back pocket. The American Opportunity Tax Credit is a credit for qualified education expenses paid for an eligible student for the first 4 years of higher education. Think about expenses like tuition, books, equipment, and school fees. You can get a maximum annual credit of $2,500 per eligible student, 100% for the first $2,000 of qualified education expenses, and 25% of the next $2,000 of qualified education expenses you pay for that student, totaling $2,500. I also mentioned earlier, this credit is partially refundable. So if the credit brings the amount of taxes you owe to zero, you can have 40% of any remaining amount of the credit, up to $1,000, refunded to you. In order to be eligible, your child needs to not have finished first 4 years of higher education and also be enrolled at least half-time for at least one academic period. This credit is also available on per student basis. So if you have more than one student in college at a time, this credit still works. Moving on, in the spirit of education, the number 3 tax credit you want to be aware of is a lifetime learning credit, also known as LLC. This credit also helps to offset the cost of post-secondary education, but it differs from the American Opportunity Tax Credit in that it is available for any years of post-secondary education, not just the first 4. Think of graduate school, supplemental undergraduate classes, or any courses to acquire or improve job skills. In addition, there are no limit on the number of years you can claim the credit. It is worth up to $2,000 per tax return, but unlike the Opportunity Tax Credit, the Lifetime Learning Credit is not refundable. Both my wife and I have taken good advantage of this credit for many years, given we both pursued higher education and took supplemental classes after college. If you've been on the fence about going back to school to pursue higher education, this could be a good tool to consider as you weigh the overall cost. The number 4 tax credit you want to be aware of is a Child Tax Credit, also known as CTC. This is a pretty straightforward credit if you have kids. The credit, currently up to $2,000 for each child, in a family under age of 17 at the year end, is a dollar-for-dollar reduction in taxes that many families with children can claim. It begins to phase out at $400,000 of adjusted gross income for married filing jointly, and $200,000 for single filers. The credit is also partially refundable. Some taxpayers may be eligible for a refund up to $1,500 even if they don't owe any income tax. There are some criteria for qualifications though. For example, each child needing a social security number, having lived with you for more than half the year, and being properly claimed as a dependent on your tax return, so you want to make sure you meet all of them. In the theme of children, the number 5 tax credit you want to be aware of is a Child and Dependent Care Credit, also known as CDCC. The Child and Dependent Care Credit helps offset the cost of babysitting, daycare, and after school. It's available to people who pay for childcare for dependents under age 13 in order to work or look for work, with the primary reason for paying the expense to ensure the individual's well-being and protection. The credit is also available for the cost of caring for a spouse or a dependent of any age who is physically or mentally incapable of self-care. The total expense that you may use to calculate the credit may not be more than $3,000 for one qualified individual or $6,000 for 2 or more qualifying individuals. The percentage of your qualified expenses that you can claim ranges from 20 to 35%, with more you earn, the lower the percentage. Also for 2022, the credit for child and dependent care expenses is non-refundable. This is another credit that both my wife and I really benefited from. Given we had both our kids in daycare, preschool, and after school for much of the past 10 years, we've saved combined thousands of dollars over the years in taxes through this one credit alone. If you're currently paying out of pocket for childcare, make sure not to miss this credit. The number 6 tax credit is not for everyone, but if you adopted recently, you want to be aware of the adoption credit. For the tax year 2022, this credit covers up to $1,500 in adoption costs per child. This credit begins to incrementally decrease at certain income levels and completely phase out once your 22 modified adjusted gross income exceeds $260,000. This credit is also non-refundable, which means, as stated earlier, it's limited to your tax liability for the year. However, any credit in excess of your tax liability may be carried forward for up to 5 years. I know of families who've adopted, and I know how expensive they could be. So anything you can do to offset the cost can be helpful. So make sure to take advantage of this credit if you adopt it or are planning to adopt anytime soon. The number 7 tax credit you want to be aware of is a Retirement Savings Contribution Credit, or also known as Savers Credit for short. The Savers Credit is a tax credit worth up to $1,000, $2,000 if married filing jointly, and is made specifically for mid to low income taxpayers who contribute to a retirement account. The government wants you to save for retirement, so much so that the IRS offers the tax credit for doing so. The value of the Savers Credit is calculated based on your contribution to a traditional or Roth IRA, Simple IRA, 401k, 403b, or 457 plan. You may be eligible for 50%, 20%, or 10% of the maximum contribution amount, depending on your filing status and adjusted gross income. The Savers Credit is non-refundable, and also to qualify, the contribution must be new money. In other words, rollovers from an existing account like the 401k rollover into an IRA does not count. However, understand that it's primarily geared towards mid to low income earners. So it's something to look at if your adjusted gross income in 2022 was less than $68,000 if married filing jointly, $51,000 if head of household, and $34,000 if single. For 2023, these numbers increased slightly. $73,000 if married filing jointly, $55,000 if head of household, and $37,000 if single. The number 8 tax credit you want to be aware of is the Earned Income Tax Credit, also known as EITC. The Earned Income Tax Credit is also targeted to help mid to low income workers and families get a tax break. For the 2022 tax year, the tax credit ranges from $560 to $6,900 depending on the filing status, income, and number of children. Earned Income Credit is a refundable tax credit, and to claim EITC, you have to meet income qualifications and cannot make over a certain amount of investment income. You don't have to have children in order to claim the credit, but generally the more children you have, the higher the credit amount it will be. If you fall within the guidelines for the credit, be sure to claim it on your return when you do your taxes. And if you didn't claim the Earned Income Credit when you filed your taxes in the last 3 years, but think you qualify for it, the IRS encourages you to file an amended tax return so you can get that money back. The number 9 tax credit you want to be aware of is the Energy Efficient Home Improvement Credit, a non-refundable credit to help incentivize energy efficient investments. Through December 31st, 2022, the Energy Efficient Home Improvement Credit was a $500 lifetime credit. However, amended by the Inflation Reduction Act, the Energy Efficient Home Improvement Credit was increased for years after 2022, with an annual credit up to $1,200. Because the new credit has an annual limit rather than a lifetime limit, if you can manage to spread out your qualifying home improvements over the 10-year life of the credit, you could receive up to $12,000 back on your taxes as compared to only $500 allowed under the previous credit. Common items can cover our home energy audits, new windows, upgraded central AC units, and hot water boilers. However, for many of these, there are annual dollar credit limit for each specific item, so you want to check on your specific credit amount on the IRS website or with your accountant. In the line of energy efficiency, the number 10 tax credit you want to be aware of is the Residential Clean Energy Property Credit. Again, another non-refundable credit to help incentivize energy efficient investments. The Residential Clean Energy Credit, also known as RCE, is another credit extended and expanded by the 2022 Inflation Reduction Act. The credit is worth 30% of certain qualified expenses for residential clean energy property. The Inflation Reduction Act extended and modified the existing energy credit through 2034, modified the applicable credit percentage rates, and added battery storage technology as an eligible expenditure. The credit applies for property placed in service after December 31st, 2021 and before January 1st, 2033. Starting in 2033, the credit percentage rate phases down to 26% in 2033, then to 22% for 2034, and finally to no credit being available after December 31st, 2034. Equipment that qualifies for residential clean energy tax credit include items like solar panels for generating electricity, solar-powered water heaters for water use inside the home, and even battery storage technologies that we referred earlier. That's it, guys. Thank you guys for watching. I know tax credit is not the most exciting topic, but if you understand them, they have the potential to save you thousands of dollars in the long run. In the line of overall efficiency, if you'd like to learn more about making your home more financially efficient, please check out my video here. Until next time, all the best.